This picture illustrates how mutual funds work. A group of investors pool their money together. This usually happens by someone raising money for a fund they want to start. The fund manager then chooses what securities to put the money in. Then the fund hopefully generates returns which gets passed down to the investors or reinvested in the fund. Let's go over some important things to know about mutual funds. The price of a mutual fund is based on its net asset value, plus any brokerage expenses, fees, or commissions. Its net asset value, NAV, is determined by the total value of the securities divided by the number of funds' outstanding shares. Mutual fund investors do not actually own the securities in the fund. They only own shares in the fund itself. Now I'm going to go over some mutual fund structures. So you have open-end, closed-end, unit trust, and ETFs. Open-end funds is a diversified portfolio of pooled investor money that can issue an unlimited number of shares. Closed-end funds holds an IPO at launch, and the money raised from that IPO is used by portfolio managers to buy securities. A unit trust is an unincorporated mutual fund structure that allows funds to hold assets and provide profit that goes straight to the individual unit owners instead of reinvesting them back into the fund. ETF share prices fluctuate all day as the ETF is bought and sold. This is different from mutual funds, which only trade once a day after the market closes. There are many types of mutual funds that use different investment strategies for what they invest in. For example, a growth fund. A growth mutual fund will invest in stocks that are experiencing high growth, while an income mutual fund owns securities that is expected to pay an interest or some distribution, for example, debt securities or other dividend paying stock. A thing you should consider when investing in different types of mutual funds is your risk tolerance. A growth mutual fund will be higher risk than an income fund, but may also give a higher return. Other types of mutual funds are high yield, emerging markets, social responsible funds, real estate funds, international funds, and there are also many other. I encourage you to look into the different types of funds if you plan to invest or just want to understand funds better. This is an example of a fund, the Franklin Growth Fund. It is a growth fund, like we discussed earlier. This is a different fund. It's focused on value stocks and large cap stocks, so big companies that are considered value stocks. LVHD is a ETF. It focuses on high dividends and low volatility, so it invests in stocks that have a history of high dividend. The Frank Equity Income Fund is another fund focusing on income securities, like we talked about earlier. Let's dive a little deeper into what an ETF is. An ETF is a basket of securities that you buy or sell through a brokerage firm or a stock exchange. It's a type of an open-ended fund, meaning that an infinite amount of shares can be issued. ETFs are traded at the stock exchange and their market price can vary from their net asset value. Say we have an ETF where the underlying index is the S&P, meaning that they own the same stocks as the S&P. The NAV will be the same as the S&P 500. However, sometimes you see the ETF being sold at a lower or higher price than the S&P 500 because the ETF is traded separately. Now I'll go over some different types of ETFs. You have index ETFs. They're designed to track a particular index like the S&P 500 or the Nasdaq. A commodity ETF, they're designed to track the price of a commodity such as gold or oil or corn. Then you have foreign market ETFs designed to track non-US markets such as Japan's Nikkei index or Hong Kong's Hang Seng index. Fixed income ETFs are designed to provide exposure to virtually every type of bond available: US Treasury, corporate, municipal, international, high yield, and several more. So, how does an ETF work? During the day when the stock exchanges are open, an ETF is bought and traded much like a company stock. An ETF, like a stock, has a ticker symbol, and intraday price data is easily available during the trading day. SPY is an example of an index ETF that tracks the S&P 500. It's the oldest surviving and most widely known ETF that tracks the S&P. IWM is another ETF. It tracks the Russell 2000 Small Cap Index. QQQ tracks the Nasdaq 100 index, which typically contains technology stocks. You also have the DIA. It represents the 30 stocks of the Dow Jones Industrial Average. Let's go over the main differences between ETFs and mutual funds. Management style. ETFs are passively managed to match an index or investment style, while mutual funds can be passive or actively managed. So the management decides what stocks or bonds to invest in. Liquidity. Because ETFs are traded on an exchange, they can be acquired or sold anytime during the trading hours, while mutual funds can only be sold and bought once a day. Price information. ETF prices are available for real time investors. Mutual funds are only priced at the end of the day. NAV, net asset value. ETFs can be traded at a premium or discount to their value, but mutual funds are always bought at their net asset value. Next, we're going to go over bonds.